Yesterday we wrote an article. It was whether Comey's firing might suck the oxygen from the Trump agenda. And I've got to say how polarised were the responses. KBW, Brian Gardner, the firing is a bad sign for tax reform. Evercore's Terry Haynes doesn't see the Comey firing impacting timing of tax reform or ACA reform. So where are we? Where does Goldman Sachs Asset Management sit between those two arguments?
Well, I guess I'd say we're probably closer to the second one, which is probably doesn't change it all that much because it's going to be a long slog. It does seem like there's going to be a lot of work here. You know, when we think about the backdrop and what's going on in the U.S. economy, you know, we think of the political agenda as an upside risk. We have a pretty positive outlook on U.S. economy, U.S. growth, U.S. labor conditions. Yeah. And I think if you can get some of these things that probably would be more positive, that could be potentially stimulating, that could just add fuel to the fire. But we're not, you know, holding out for just that.
Well, I want to dig into that a little bit more. I wonder if the market reaction yesterday, which was very muted, very subdued to all of the action down in D.C., was more a result of a market that actually is positioned to ignore D.C. now, and actually they no longer think it's relevant, and the hopes for stimulus, say, back in December, January, February, are not there in the same way. Would that be an accurate read? Yeah,
I think that's an accurate read. It seems to us that the market is just not really focusing on anything. You know, it's unbelievable how complacent market participants seem to be. You look at all of these indicators of volatility, of market volatility, not just realized, but forward-looking, implied volatility in the various markets. And you see that in equities, you see it in credit, you see it in interest rates. Really across the board, you know, markets are really looking past almost all risks that are out there.
So explain this, John, because after the election, the markets went up, right? Yep. Stock market in particular stayed up, didn't come back down, still setting records, okay? Mm-hmm. Now, after the election, we all were saying, and maybe it's our fault, we're saying it's the Trump trade. It's all about Trump. Now we're saying, well, don't count on Trump, the markets stay up. Is that because we were wrong to begin with, that it really wasn't the Trump trade, there was something else going on?
Well, I think it was a combination of things, so I don't think it was wrong necessarily. I think there is still a possible upside surprise, right? So when markets price in the potential outcomes, and I think the market is saying that the upside risks are greater for the first time in probably a long time than the downside risk. So I think there is still that hope out there, and you could see that as being priced in. But I also think that, you know, things are actually looking pretty good even before, right? So you know, we're coming through a pretty good earnings season, generally speaking. And so, you know, our view again is not that the U.S. economy needed or needs further stimulus from policy, that the U.S. economy actually is doing pretty well, and we have, you know, we're pretty optimistic about the second half. And again, that's not because there's going to be legislation that comes through. I think, you know, one of the things that maybe is you know, under focused on is just the environment of, you know, we do think that just the idea that this is perhaps a better business environment than what we've experienced over the last few years actually can have a real impact without legislation.
Oh, I see. So it's deregulation, actually, rather than the tax reform.
I think that actually is a big thing. You know, we would argue the U.S. economy doesn't need fiscal stimulus right now. You know, what it needs is to unlock productivity. And I think some of the things that are focused, the actual deregulation, or even, frankly, the lack of future regulation, actually, I think, is unleashing some of these animal spirits.
So does that answer the question, the counterfactual question I was going to ask, which is, if Donald Trump had not been elected president, where would the S&P 500 be today?
Oh, that's a tough one. First of all, I'm the bond guy, so, you know, I always want to sell all the stocks.
That's the easy way out.
So,
okay,
yeah.
I'll give you that. Where would the U.S. 10-year yield be today?
That's a good question. I actually, so the answer to your question is, just to be consistent, is I don't think it's that much different than where we are today. And again, for the same reason, which is the U.S. economy is doing well, companies are doing well. You know, and you know, the labor market is very tight. The Fed had already started to embark on a tightening policy. The market wasn't necessarily pricing it in, but I think the market isn't pricing it in now either. Yeah.
As an institution, Goldman Sachs Asset Management really coming out with some strength at the moment, talking about this complacency in markets. I caught up with your colleague Mike Swell on Friday, saying exactly the same thing. Why do we still have the mentality through which you guys describe as a buy yield at any price still? And what is it going to take to change the mentality? If the data does not do that, where's the inflection point coming from?
Yeah, it's interesting because, again, you know, when you go back a year or two, it was all about, you know, risk premiums are being depressed by everyone, including the Fed. Everybody, you know, all the central banks are extremely easy. Now the Fed is moving in the opposite direction. Yeah. Our view is they actually are, in some sense, disappointed that financial conditions haven't tightened more. But you think about the rest of the world, the Bank of England, the ECB, the Bank of Japan, they are still quite stimulative, and they do not want to put their foot on the pedal. They might stop buying, they're going to buy less assets, but that's just because there's less assets to buy. So you have this issue where the liquidity is still getting poured in. It's just coming from outside the U.S., but I think there is this massive still desperation for yield, and I think it is mostly coming out from outside the U.S. That being said, sentiment can shift very, very rapidly. So now everybody's feeling good. Volatility is extremely low. Yeah, there's these risks out there, but those aren't going to hit us. Which one? I don't see the catalyst. You hear that all the time, but of course you don't see the catalyst until it hits the front page. And I would say the markets are complacent. So yeah, I think that's why we are where we are. But we're positioning portfolios to be more cautious.